business, and we just got to keep plugging away. So anyways, there we go. On to bigger and better things. 6 steps to financial freedom. Thank you guys so much for coming on. I'm super excited to share this with you. It's a system that I've used for years and years. Well, not really years and years. Now that I think about it, I got to backtrack. I got to kind of get used to my story again. I use the bigger pile theory, and the bigger pile theory is something that I got from my coaching that I've been doing. And the coaching idea is the bigger pile theory is all about you learn from people that have already done it, have already succeeded at it, and have gone to that highest level, like the peak of success on that level. So I've learned this information from people that have net worths in the story of $10 million, $25 million. Some of my coaches, these are how successful they are. And the top of the line is the guy that runs the coaching program that I learned this from, Rick Ruby. His net worth is approaching $30 million in cash. And I'm just talking cash, like the guy is loaded to the gills, and he shows his financials to me. And I learned this from him. And, when somebody's got that kind of wealth, and he used a program since 1986, he's used this program and built amassed that kind of a fortune. It works. So I tried it in 2016. I started saving 20% or more of my net income. And I increased my net worth by 35% in 3.5 years. And last year alone, I saved over $200,000. Now, I know some of you are saying, how am I supposed to save $200,000 when I don't make $200,000? That's not the point. The point is saving the 20% will get you to the same place just as everybody else, but we got to start somewhere. I've been coached in this system now since 2016. So every month for 4.5 years. So I feel like because I've built my wealth and it got to where I'm at and I live it daily, that I can bring it to you guys and share this information with you and hopefully help you get the same success that I've experienced over the last 4.5 years. Quick overview of what we're going to cover today. We're going to talk quickly about the personal family budget. This is probably the most important piece of the puzzle. If you're not doing a monthly budget, you're missing the boat on your financial success. Most people don't do a budget. Most people say they do, but they don't write it out. You have to write it out monthly. You have to do this consistently. And the reason is you've got to know where your money is going. If you don't know where your money is going, there's no way to figure out how to save it. Big thing is save first, pay bills last. We'll go into more detail. Pay off revolving debt. You can't really save money if you're in debt. We got to get rid of the debt first. And that's what my problem was, is figuring out how to get out of debt as quickly as possible, and then getting to that savings part that is so elusive to most people. Survival account. This was a key account for me that I didn't have in 2008. I don't know if any of you on this phone call remember 2008. That was a major downturn in the real estate market, a complete collapse. I was not prepared for that and just about lost everything. And mainly it was because I didn't have any money in savings. I was one of those guys living paycheck to paycheck. I had a 401k. I'm saving. I'm prepared. No, I'm not. Got to have a survival account. Invest in 401k. I think most Americans and most people on this call might have some kind of a 401k or an IRA or something like that. It's super important to do that. It's a very beneficial savings tool, and we'll go into that in more detail. Invest in stocks and bonds. This is the big part of it. I think this is the one part that I was missing, and that's I didn't have any stocks and bonds outside of a 401k or an IRA. So we'll go into detail on that, building wealth outside of retirement, and then paying off the house. I get this question all the time from clients that are refinancing or buying a house, that they really want to pay their house off as quick as possible. And in reality, if you want to build wealth at a high level, you never want to pay off your house until you're at least 50 years old. And then you can start looking at paying off your house. However, with these super low rates, that's changed. So we'll get into that in a little more detail a little later on as well. Okay, the personal family budget, guys. This form will change your life, and I'm not joking. I had never tracked my expenses, and literally after my first class on learning how to do the personal family budget, I was able to cut out hundreds, if not close to $1,000 a month in expenses because I had no clue what I was spending my money on. And when I figured out where my money was going, I was able to start tracking it, finding areas where I can cut expenses, and literally opened up the door for me to save more and more money and figure out where I want to go there. You got to do this monthly though. So a lot of people will do a monthly budget, save it, think about it, but never touch it or really bring it up again and update it every month. So it's one of those things like, yeah, it's a hassle, but it's something that if you do, it's going to change your financial future. So if you're not doing that, we will send you a copy of our editable Excel spreadsheet with the personal family budget in there so that you can, my wife's pinging me. Sorry about that. If you're not doing a budget monthly, this is the tool. Get a copy of this, fill it out, and start using it immediately. So distribute your money as follows. So this is what we're looking at. This is an overall view of what you're doing on a monthly basis. You're saving 20%. That's first and foremost, guys. The second you get paid, you take 20% of that net check and you throw it in savings. That's the biggest mistake most people make, is not saving first. They pay bills and spend first and then save last. Living expenses, you got 30% of your income to cover living expenses. That's like your rent and your normal monthly bills. And then taxes, you got to pay the tax man. Some of you will be at 25%, 20%, up to 40%. And then giving, I know it seems odd when we're talking about giving when we're trying to save money, but giving is actually something that's very, very close to the program. And it's basically what you got to think is if you're in a point where you're lucky enough to have money and be able to save and earning income and you know, I feel very grateful for where I'm at, and I want to help people around me. And I feel like if you give a little bit, it comes back to you tenfold. Helping people is a key thing, and that's always been a part of our program, is to give at least 10% of your income. Even if you can't give 10% or don't feel comfortable with it, give something, give your time. So here's the secret to building wealth that most people don't realize. You must save and pay bills last. And here's the thing, most people go through life, they get paid, they have bills come up along the way, and they're paying their bills. And then they got, you know, they go to Starbucks, they go out to eat, and then at the end of the month, they don't have anything left. So there's nothing to save. That's the story of most people. I've talked to many people. That's what I hear over and over again, is I don't have any money to save. Well, the problem is they're not saving first. And the key with this program going forward is you always got to get paid and pull the 20% out and put it off in a savings account. I use an external account, Capital One. It's offline, or it's online, not linked to my regular checking account. So it's out of sight, out of mind. I've got the money sitting there, but it's gone. I can always get it back, you know, if I need it, but it takes a couple of days. There's an effort to get it. That's key. Make it an effort to get that money back so that it's out of sight, out of mind. Then once you've saved your 20%, then you start looking at paying your bills. Only pay your bills once a month, guys. Where you get into problems is, again, is you pay your rent or you pay your mortgage, and then you pay your car payment, then you pay a credit card, then you pay here, and then you pay there. And by the time you're done, you're so distracted on making different payments at different times of the month. Again, you're not tracking your cash flow properly. So what you got to get in the habit of is once a month, you sit down, you pull all your bills together, you get them all paid. This is after, of course, you've already pulled out your 20%. Once your bills are paid and your 20% is saved, now you know how much you have left to spend for the rest of the month. Does that mean that this is the concept that you got to get in the habit of if you want to reach this incredible financial freedom, is always save first, pay all your bills right away, right around the first week of the month, get them out of the way. And then whatever money is left over, you got to make that work for the rest of the month. It's so much easier to know how the rest of your month's going to go and what you can spend if you know exactly what that number is, versus most people just spend until the month's over and then there's nothing left. So change your mindset. This should be your mindset. On the first, I'm rich. I just got paid. Woohoo! On the second, I'm poor because I just spent all my money and I don't have very much left. So you're not this person that can just take the money and go willy-nilly to Starbucks or go out to dinner every night or go out with your friends on the weekend necessarily. I mean, those things that you can allot for those and you can budget for those, but you got to have a plan. Now, we can't have a plan and we can't even start saving, in my opinion, unless you're out of debt. So if you're currently carrying a balance on your credit cards and you're paying either a minimum monthly payment or a certain amount every month, the first step for that situation is you've got to get your credit cards to a situation where that you're paying them off monthly. If you're not paying them off monthly, the only way to do this in a very systematic way that's super aggressive to get you out of debt very quickly, literally took me about 8 months to get out of debt, and I had a lot of debt, trust me, especially after 2008. The envelope system. This is tough, guys, having cash to pay things. Now, I used a debit card instead of a credit card. That's how I changed this. So you could use cash. I mean, the old theory back in 1986 was use cash because credit cards and other things online were not as available. Now we're using debit cards and online transfers from your bank. The key is you got to stop using the credit cards and you got to start using cash only and or your debit card in lieu of your credit card, a debit card in lieu of a credit card. You basically keep paying the, I'm sorry, got off track here. Envelope system. If you're paying off credit card debt, you must use the envelope system. Once you've paid your bills, allocate the cash to other categories. Once the money in a certain envelope is gone, it's gone. So what that means is you figure out what your debts are on your personal family budget. And if you've got $300 a month allocated on your budget to your groceries, you allocate that $300 and that $300 is all you get for groceries. Once you've run out of those $300 for groceries, you got to pull money out of a different part of your budget in order to continue to pay money towards groceries. So whether it's, let's say you have like $150 miscellaneous for spending cash and you buy all your groceries and you spent $300, but now you've decided you need an extra $50. You got to pull that money from somewhere else. You can't just use it from your budget or from your normal cash that you're going to use to save. You can't pull it out of savings. You got to pull it from a different allocation that you have in your budget. That's why the budget itself, the personal family budget, is so important, you guys, is you got to know where your money's going. And if you start spending $350 a month on groceries every month consistently, then that's your new grocery budget. You got to update your personal family budget to reflect the $350 instead of $300, and then readjust some of your other categories in your budget. Again, this is where everyone loses track, is you start spending money without tracking it, and at the end of the month, you have nothing left. It's so important to get a hold on where the money's going in order to build wealth. After all the bills are paid and your cash is allocated, you can take the remaining cash and pay down all your revolving debt. So this is the place where you can just maximize paying down your credit cards as quickly as possible. Is you pay all your bills as soon as the cash comes in, and then you have your allocation for the spending money you need for the rest of the month based on your budget. And then any extra money, you just pile into credit cards and pay them off. And I know I'm making it sound kind of easy, like there's all this money that you get to pile into credit cards at the end of the day. And quite frankly, if you do go through the budget system and you figure out exactly where you're spending money lot by lot by lot, and each allocation, you're going to find places where you can save $50 here, $10 there, $100 here. All of a sudden, instead of having maybe an extra $75 that you send to a credit card, you have an extra $250 or an extra $300 to pay a credit card down. Now, the next thing you do is you keep paying it at that level, and all of a sudden it gets paid off a lot faster. The key is we got to get super aggressive. If you guys want to get out of debt, there's only one way to do it, and you have to get super aggressive and make sure that you're following a budget to put you on the right plan. And of course, life throws challenges at you left and right, the car breaks down, things like that. Those are things that we have to overcome. But as long as you keep an eye on the target, which is keeping your personal financial budget dialed in so you know exactly where your money's going, it's going to be so much more helpful for you to overcome those issues. Like a lot of people are living at the end of the month, they have no money left, and then the car breaks down. Guess what they do? They use a credit card. Now they're in further in debt. Versus the person that has money left over on a monthly basis that's trying to pay off debt, they can use that extra money. Maybe one month they can't pay it down the debt, but they can use that for those big expenses that might come up along the way. And I've had those expenses, guys. I mean, I'm telling you, this system works on all levels, and I've worked on all levels of this as well. Once your cash is gone, you cannot use credit cards for any further expenses. So budget wisely, guys. You got to use the budget really systematically to help you grow. Now, worst case scenario, yes, the car breaks down and you've got some money left over, but you don't have enough to cover it. You're going to have to use the credit cards, but you got to stick to the system. You can't lose the system. You got to check your budget every month. So the credit card system. Now, if you're someone that already is at the level where you've paid off all of your credit cards and now you can get to a system where you're paying them monthly and you're not carrying a balance any longer, you do want to use credit cards for a couple of reasons. One is you're building credit, obviously. Credit's super important in our society, so you have to be good credit. But also you got to have the access to a credit card for renting cars, buying plane tickets, things like that are inaccessible in other ways. From that standpoint, the key is you don't need more than one credit card, 2 max, one for business, one for personal. Here's the thing. This is the biggest excuse I get from people, and I've heard this a million times is, oh, I use my credit card because I get air miles. Or I bought a Gap, I went to the Gap and they gave me 30% off. Well, the Gap gave you 30% off because their credit card charges you 26% interest. That's why the Gap gave you 30% off. They're trying to get you to use their credit cards. So that's the reason why it doesn't make sense to try and use a number of different credit cards. I would much rather have $10,000 in the bank than a few thousand frequent flyer miles. I don't know if any of you have frequent flyer cards. I have a Bank of America, Alaska Airlines card, and the blackout dates and trying to get free tickets on that is impossible. And the actual cost versus what you get for how many miles you have is ridiculous. It's a ripoff. So there's no point in using an Alaska Airlines card for miles. I actually switched my Alaska Airline miles to a Capital One card that gives me cash back. Now I just get checks every once in a while. And when I pay off a certain amount, they send me a check for cash back. The reason we only want one credit card is it's easier to manage. Again, if you have 3 or 4 or 5 different credit cards, it takes 3 or 4 or 5 different payments. It takes more time to pay them off, and you spread your money thinner over a wider range of different payments you have to make. It's always essential to have the least amount of payments as possible so you can focus your money on paying off any debt that you have. You should have one credit card, maybe a car loan, and a mortgage. That way you can focus all your funds on savings, building your savings and your wealth. And then if you have debt that comes up, you can focus in on one credit card and pay it off immediately rather than spreading your money out over 5 or 6 cards. It was hard for me. I had 6 or 7 credit cards. I had, a Nordstrom's card. I had a Bank of America, Alaska card. I had a business card. I had the Macy's. I mean, every card you could think of. And after getting rid of all those and taking the effort out of having each card with me when I'm shopping at a certain store or whatever, it just eliminated a lot of hassle in my life, and clarity was so much better. Every month, give yourself a cash allowance. Like, no one can live on nothing, right? You got to give yourself some kind of money to spend. But here's the key, guys. Do it in cash. This is the only place that I always carry cash on me is when I'm doing my own personal spending money. And the reason you do it in cash is once the cash is gone, you can't spend anymore. And what I've found, and I've had other people tell me this, is if you know you have cash in your wallet and that's your cash allotment for the month, you start to protect that cash way harder than you would if it was on a credit card. A credit card's so easy to whip out because it doesn't have anything affected to it and it's still right there in your hand and it's the same credit card. But if you got $100 and that's all you have and you just spent 50 of it and all you have is 50 left, you start thinking, holy crap, I only have $50 left. You start thinking about it. You know what I'm saying? It makes you more conservative naturally, and you protect that cash so that it lasts longer and you don't spend as much money that way. You rethink going to Starbucks every morning. You rethink going out to dinner when you're gonna use up your last 50 bucks and there's 2 weeks left in the month. You see where I'm going with that? It changes your mindset and the way you're thinking. Never want to overspend too. Once you're $200, you can't use a credit card. Purchase above 20, you can put on a card. As long as you're paying it off monthly, you can pay it on a card if you want. You don't have a ton of credit cards. A ton of credit cards usually equates to a ton of debt. I mean, talk to anybody that has multiple credit cards and usually they carry debt. I see people every day. I pull their credit. And if they have more than 2 credit cards, they usually have a ton of debt on all of those credit cards. The people that usually have 1 or 2 usually pay them off monthly. It's weird how that happens. And they usually, the ones that have 1 or 2 cards typically have better credit scores. So here we're getting to the 4 pillars of building wealth. So now if we look back to what we just talked about, we got personal family budget dialed in. We know where our money is going now. We're put in our position to pay off all our credit card debt, get out of debt once and for all so that we're paying our credit cards off monthly, and we're starting to focus in on savings. And this is where the building wealth happens. And this is a really key integral part of this whole process, is figuring out, where do I start investing my money? Where do I put my money to put me in a situation where I'm starting to build wealth? So the 4 pillars of building wealth are savings, real estate, stocks and bonds, and retirement. And we'll go through each one of these right now. One of the main ones that I struggled with, and I mentioned it earlier, was having a reserve account, emergency fund, a savings account. I didn't have one in 2008. So when the market crashed and my income was cut by about 3/4, I didn't have any money to fall back on. It was a very scary time. I started draining my home equity line of credit. I had to pull money out of an IRA just to make things meet because I didn't have money in savings. So the very first thing you got to do, and I rarely see this too, which is scary, is you got to have an emergency fund. An emergency fund is usually equal to 3 to 6 months of your monthly expenses. So the way I look at the 3 to 6 months is, if you're a W-2 employee and you're at, you have a good job and you're not really concerned about it, and you make good money or whatever, 3 months is probably enough for most people if you're in that situation. If you're self-employed like I am, or like, a lot of real estate agents on this call are, or any of our clients that are self-employed out there, I typically stretch out to about 6 to 12 months. Because who knows when our next paycheck's coming in when you're self-employed, right? We can't plan for that. So I prefer to have more money in there. Right now, I'm running at about 12 months in my emergency fund. I have 12 months of living expenses. I'm probably overfunded right now, and I probably need to move some of that money out of there. And I'll get into that in a little bit. But I want to be safe right now. The market, rates went up. Who knows what's going to happen with these low rates for the long term? I think the market's going to be great for the next couple of years, but I just want to be prepared for the, if it does turn. So for me in real estate, I'm a little more protective. So you kind of look at your personal situation and how confident you are on your job, the economy, and things like that, and then make a determination of whether you feel more comfortable with 3 to 6 to 12 or even more. I know one of my financial advisors that I work with, he actually stores 2 years in savings, just to be really safe. So that's overzealous, but that's what he does. You keep the money in a separate account. Again, I have a Capital One online 360 account. It actually earns a really high yield. It's like a 0.5% yield, which is high for a savings account. You want to keep it separate because you want to keep it out of sight, out of mind. You do not want to save it in your regular checking account, because when you see that balance on your checking account, it's so easy to transfer it and make it usable. You've got to take that out of play. So you got to have a third-party account. As this account grows, move money from this account into stocks and bonds. So this is the other thing I was saying is, so You start saving, you put money in savings, you're 20%, you save, 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 save. As you get up to, you've hit your 3 months, and if that's where you want your reserve account at, now you can start pulling money above the 3 months, and you can pull that and start investing in other places like stocks and bonds. And we'll get into stocks and bonds in a minute. But this is the very first tool that we're going to start using to build wealth, is get some cash in the bank. Now, the next step is once we start to build savings and things like that, we can start looking at buying in real estate. Real estate is by far one of the most important steps in building wealth. You need a place to live. And if you're renting, you're throwing money away. So if you don't own, you need to figure out a way to get into a house. There's ways to buy a house with zero money down. There's ways to get into a house with as little as 3% down. Figuring out those options. Once you feel more financially stable, reach out to someone like myself in mortgages, get pre-qualified for home loans, see how much you qualify, and get into mortgages. Real estate, before 50 though, never prepay your mortgage. Again, I've talked about this and heard from many people that call me all the time. They want to pay their mortgage off early. That is not a good thing to do when you're trying to build wealth. The reason is real estate is one of the best investments that can be leveraged. And when I say leverage, you can borrow money against it with very little money down at a super low interest rate, especially right now it's super low, below 3%. And you can have that asset that grows in two ways. Every time you make a payment, the balance goes down. And as the value of the property goes up, that area in between where my head is right here, that's called building wealth. That's how you build wealth, guys. And because you can leverage it, it takes very little money out of your pocket to do it. And the best thing about it is you get to live there too. So it's got like all these benefits. So I would never recommend prepaying your mortgage. Now I'm 51 and I should be starting to pay off my mortgage, but my mortgage is at like 2.625%. And the stock market returns historically about 12%. Why would I pay off my mortgage at 3% when I can make 12% in the stock market? So I've chosen not to pay my mortgage off even now. I'm going to continue to keep an eye on the stock market and continue to grow there rather than waste my money on trying to pay my mortgage off when I can make more money in stocks. House value equal to 3 to 4 times your gross annual household income. That's a rough rule of thumb. So if you make $100,000 a year, you should buy a house up to about 400,000. I mean, in the Seattle market, that's not a good rule. This is from the East Coast, so it's a little different on North Carolina than it is in Seattle. So we'd have to update that to about 600,000, so about 6 times the income out here in the Seattle area. But you can go even higher. I mean, it depends on your comfort level and what the payment is and how much other debt you have. Like if you have lots of car loans or things like that, we have to kind of splay that down a little bit. Real estate value never to exceed 50% of your net cash worth. So again, you don't want to be real estate heavy. And I've said this a couple of times, you don't want to have all your eggs in one basket. That's a big real estate investing guideline. And having more than 50% of your monies in real estate puts you in a precarious position investment wise. So there's just a rule of thumb is 50% of your cash net worth. Second homes are great. They love having a second home. I guess the motivation behind having a house or getting a second house is having a house and a higher payment motivates you to be more functional at saving and paying attention to your finances. That higher payment on a mortgage has historically shown that people are more aggressive on saving when they own a house because they have that higher level of investment and requirement that they have to make that payment and they don't want to lose the house. Once you exceed 3 million in assets, you can buy commercial real estate. Just as you grow and grow and grow in your financial wealth, you want other opportunities, and commercial real estate is something that can get to that next level. Again, the guy that put this together is worth like $30 million, something crazy. So he owns real estate and commercial. So he wanted to kind of give that upper echelon as well. Okay, stocks and bonds, you guys, this is probably this is one where everybody misses. And the reason they miss is because they don't understand it. This account's the most important because most Americans have no money invested in outside of retirement accounts or savings. So most people say, I have all money saved, but they're just saving in their 401k, or they have an IRA. But the problem is you can't access that money until you're like 70, right? So if you want to retire early and not be worried about what you're going to retire in, you've got to invest in stocks and bonds. Stocks and bonds grow at a major clip. You can see the number down here. The current average annual return from 1923, which is the initial year of the S&P, is 12.16%. I just updated that average. Through 2016, it was 12.25. Up to this year, it's 12.16. I mean, 12% return on anything, you guys, is an amazing number. That basically means you just put money in there and it continues to grow over time. And that's what we have to have, is we have to have vehicles that are greater than a savings account, but not protected in a 401k, so that we can build wealth at a greater clip. And this is one of the pieces that is missing in most people's financial breakdown, is they don't have stocks and bonds. They may have stocks, like I talked to a lot of like Amazon employees or Microsoft employees, and they have a lot of Amazon and Microsoft stock, but they're not diversified. They have all their money in the company stock. You got to get diversified. The biggest issue with most people is they don't understand stocks and bonds. Like, how do I invest? Where do I start? How do I get an account? Guess what? Oh my God, we have a class coming up next month that piggybacks on that. Demystifying stocks and bonds with a certified financial planner, Mark Naus. So if you guys have any questions on stocks and bonds, please sign up for this class, because this is a piggyback on this class to get you guys. This class will walk you through how to set up an investment account, looking at stocks and bonds, how to buy them, and everything else. So now we're taking that out of the mix and putting the power in your hands. And he's actually got an amazing new program that they just rolled out for new investors that helps you get the advice you need without having to have the minimum net worth. Most financial planners want between a $250,000 to a $500,000 net worth. This program that they did came out for new investors has a $5,000 net worth. You just have to invest $5,000. So it's a very low barrier of entry, but it allows you to start getting into investing and learn about it. And they have a great program for that. So check that one out if you can get to that event next week on March 16th at 10:30. Okay, next step is the retirement. So we talked about stocks and bonds. We talked about savings, retirement. Most people know about this one. You probably have a 401k or an IRA. If you're self-employed, you got to have an IRA. If you're working for a company, you have to have a 401k. The minimum you want to contribute is the match, the company match. Most companies have some kind of a match. NFM here, I think, has a 6% match. So they'll match up to 6% of my investment into a 401k, and they'll match it either dollar for dollar or 50 cents on the dollar or something like that. That's literally free money, you guys. You got to take advantage of that. This is the only investment that you would do if you still have credit card debt and you're not paying enough monthly, is you would match your employer match in the 401k. So if you're not doing your 401k, you're missing the boat. One, you're missing out on the free money. And then here's the key that most people don't realize is when you invest in your 401k or an IRA, in a lot of cases, that money goes in there tax-free. So even if the market returns 0%, you make 15 to 20% plus on your return because you didn't pay taxes on that money. So you just saved yourself whatever your tax base is on the return. Now, if you don't have a 401k, get into an IRA. And if you don't know how to do an IRA, we just got to get on that call with Stocks and Bonds, and Mark Naus can talk about that as well. But an IRA is super easy to set up, and you can move that money in there, especially if you're self-employed, like real estate agents or anything like that. There's tons of good programs out there. There's even an individual 401k that you can set up for very little money, or just get an IRA. They don't like Roth IRAs. Roth IRAs are different. That means you put the money in already taxed. So you get paid your money, and then you put the money into a Roth IRA. Then it grows tax-free. The problem is you lost 20 to 25% putting the money into a Roth IRA right out of the gate. So it makes more sense to put the money in there pre-tax, so you don't lose the 20% tax or 25% or whatever it is. And then it grows tax-free as well. So the advantage of a IRA over a Roth IRA is the money's going in there at a higher level. So no Roth IRAs. And dang it. get out of there. This statement down at the bottom was kind of surprising. 78% of Americans are concerned they don't have enough money to retire. I mean, isn't that a staggering quote, you guys? I mean, that's kind of scary. I don't even feel like I have enough money to retire. And I'm so glad I found this program that's put me on this track to get me to the point where I feel like I'm going to be more comfortable here in the next 5 to 10 years. All right. So we talked about everything there. Now, what I want to get into with you guys is just show you the personal financial budget. I'm going to go over it very quickly. And if you guys, anyone wants to reach out to me directly, we can talk about the personal financial budget, even more depth if you want. Just reach out to me anytime you want. So we'll send this out to you. But basically, you got column 1 on the personal financial budget. Has everyone got this form already, Jalen?
Yes, it was sent out to everybody's emails this morning. And if you didn't receive it, I can go ahead and do that for you right now if you want to send me a private message.
Cool. Perfect. So basically, I mean, the goal of this is track everything you owe. I mean, I literally had to break down every kind of expense that I had from, I mean, this isn't mine specifically, this is just an example, but you got your mortgages, you got credit cards, and then you got every bill that you can possibly think of all the way down, like spending money, house cleaning, doctor, groceries, blah, blah, blah. So make sure, this is super key. Anytime you spend money, anywhere it goes out, you got to list it on this form. And yes, you can group some things together, but you got to be honest with yourself. If you're not honest with yourself, it's not going to work. Now this column 2, so you have your list of bills. Column 2 is the monthly owed minimum. This is probably one of the more important columns because this establishes your survival number here at the bottom. And our survival number is what we're going to use to kind of set up our emergency account, our savings account. This is how much we want. The 3 to 6 months of our survival number is the total. So in this column 2, you're going to put the minimum monthly payment for everything that you pay on a monthly basis. So you can see groceries, doctor, gas. One thing you don't put in this column though is like luxury items. So like here, this guy's got house cleaning. It's 0 because that's a luxury item. If the world hit the edge and all of a sudden there was nothing left and this person had to go to their survival number, they could cancel the house cleaning, right? So you wouldn't include that in your house cleaning. Basically, what's included in column 2 is everything you need to survive without having to come up with any other income and be able to pay all your bills. So that means on your credit cards, it's the minimum monthly owed. So like on this statement, $4,500, his minimum payment is $89 a month. Gas bills, $350, blah, blah, blah. His survival number for this person is $5,899 a month, and that includes his mortgage and everything else. So column 3, this is the total monthly paid. So now this column is what you actually paid for the month. Now this isn't your survival number. This is just what your monthly outgo is on a monthly basis. So here's his mortgage. Here's all those credit cards and all the monthly bills that he was paying out. And boom, he's got the total of checks wrote. Whoops. Column 4, amount saved. So this is just adding up anything that you saved for that month. If you're in a 401k, that number would go over here as well. It would not go in this column 3 because it's not been, you paid it, you got it pre-tax. Once you guys see the form, you'll see what I'm talking about, but there are some innuendos to it. So if you have questions on the form, like I said, shoot me an email or give me a call and we can chat more detail about how it works. But you'll see it and it should be worked. All the columns will auto total and everything else for you. So it's pretty slick that way. Column 5, you put all your income in and total at the bottom and auto totals. But paycheck 1, paycheck 2, you can see there's other things that could come in. Anytime you have money that you put into your bank account, it goes on the total paycheck. So let's say you get a refund from your insurance company for $150. That would go under here, insurance refund. You got one for 50 bucks. Here you got a rebate back from somebody and it was 10 bucks. Anything that goes into your saving or your checking account goes on there. So basically the way I do it is on the beginning of the month, I pull up my Bank of America checking account, and I just look at all deposits for that month previous. And that shows me all the deposits, and I put them all in and I just list them on here. So in my case, my wife works as well. So I have paycheck 1, Margot, paycheck 2, Margot, and then I got paycheck 1, Jeff, and paycheck 2, Jeff. And then if there was a refund or anything else or any other deposits in there, I would have those in there. Even if it was a gift or a birthday present or something like that, you would list it on here as income that goes into your checking account, and then you total up. Total paychecks, hourly's amount equals total amount paid out. And then the difference is savings in between. This is kind of a confusing one. So if you have questions on this, let me know. But basically, the total amount out is the total amount in. This is my favorite part. This gets me all aggressive on savings. And I think when you start watching this and you start doing this monthly on your personal family budget, and you start seeing how the numbers start to grow and how quickly it happens, you'll get more aggressive and more aggressive. I mean, this form like blew my mind. And as my wife and we started looking at it together, she got more motivated about saving, cutting costs. I got more motivated about saving than cutting costs. And then you started to see the balances grow. Like this guy saved 38% of his gross income or net income. This is net. I mean, that's an amazing number. So basically, he made 11,000, but he saved 4,200 based on all these savings things that he put into savings and 401k and things like that. So he saved 38%. This number motivated me as well. There was months where I had 70% savings on my income. I mean, I just got super aggressive and I stopped spending money. It was just weird because that's not me. I'm a spendthrift. I love spending money. But this changed my mindset, guys. I'm telling you, this is super powerful. Now you list out here other things you have, like here's my 401k balance. Here's another 401k balance. Here's a Fidelity account this guy has. Here's Wells Fargo. Here's a 529 plan, equity in his house, and then equity in rentals. So these are watching and tracking how everything grows. One of my favorites here too is saved. Oops. How much you saved year to date. So every month that goes by and you have an amount that you save for the month, you add that into your saved year to date and you watch how much savings is growing, both in your 401k and in your money market balance. This money market balance, it doesn't have to be a money market account. This is my Capital One. And again, this isn't my stuff, but this money market balance would be your online savings account that you put your savings in and things like that. And then giving down here too. Don't forget about giving away to the church, giving away to the family, giving your time. Track everything to kind of see how your net worth is building. When we get into giving. So again, I mean, this is super important, giving away. I mean, just last Christmas, we gave away $15,000 to 3 different charities, 5,000 each. And it was just an amazing opportunity to give back just because of how grateful we were of being in business and being as busy as we are. And, you know, they were very grateful for that. And it just makes you feel good about everything that you're doing. And if we're getting aggressive on savings, we also want to kind of help the people around us to make the world a better place. All right, guys. So I went through that last part a little fast. Does anyone have any questions, or do we have questions, Jalen?
We do have one, but I want to give people a chance to ask questions about the personal family budget first. So if anybody does, feel free to unmute, write in the chat, whatever way you feel most comfortable.
I'll just go through some of these in the chat real quick too while I'm on here. Like Fran, I said use Mint. I mean, Mint's great. That's a good program to use. You just got to make sure. I like the personal family budget and I like it printed out. Like I do it online and plug all the numbers in. But when I first started, I printed the form out with, I had my bills on column 1. I had my bills in there, but then I would print it out in the first part of the month. And my wife and I would sit down and go through the bills manually, and I would handwrite them in there. That's super powerful, you guys. Then after several months of doing it that way, we kind of got in the rhythm of how it works. And once you get in the rhythm, it becomes easier and easier and quicker and quicker. And then I started doing it online, meaning that I had it on my computer and I would just pull up my computer and then we would go through and plug in the updated numbers and track everything that way. But I'm telling you, if you're starting out and you have credit card debt and you really want to get aggressive at this, it's got to be real. And real to me is printing it out, holding it in your hand and writing the numbers on a piece of paper. So I like Mint because it does track everything and it does a lot of it easily for you. You just make sure that you're budgeting out the different aspects, like how much cash you have to spend to the end of the month. And you got to pull that out of the budget. So just make sure it's very clear of where the money's going and how much you have to spend. And the other thing for on too is just make sure you're saving that 20% off the get. That's the key. And I don't care if you don't have the 20% to spend, or excuse me, save. What you want to do is save the 20%, pay your bills, and then live. And if you run out of money, it's okay to go back to the 20% and pull a little bit back, at least initially, until you get used to it. But I'm telling you, you will get used to it. You'll get used to trying to live on the money that you have. And it gets even better when you start to see the savings building. Like every month you're saving that 20%, that number skyrockets very quickly. So even if you have to pull a little money back to make a couple extra bills or whatever at the end of the month, at least you still have money going in there constantly and you get in that habit of saving first and spending last.
So Jeff, we had a question from Catherine, just talking about another one of the pillars of building wealth. We talked about how investment properties are really not a good option, but what about condos? How do you feel about condos?
I mean, investment properties can be good. They just have, how do I say? I mean, condos, investment houses, everything else, I mean, they're all fine. I mean, I don't have an issue with those necessarily. It's just investment properties have a lot of work that have to go into them. So if your challenge is to go out and buy a bunch of investment properties, now you have to manage them. And what ends up happening is, as you're managing those investment properties over time, it takes a lot of out of you. And in the end, I don't think you necessarily make as much money as you can in stocks or bonds. I mean, the difference to me is like, I used to have rental properties and I sold them all. And the main point is I put all my money in stocks and bonds and I don't have to do anything. I just let it sit and it grows and I don't have to manage it. I don't have to think about it. I don't even worry about it. I have payments. I just throw my money in there. So I'm kind of on the fence on investment properties. I have some good clients that they've had 10, 15 investment properties. And now one guy in particular just got to the point where he sold off 6 of them. He still retained like 3 or 4 of them. And he's got like a nice income from all that money that he sold from selling all those investment properties. And now he still kept a few that he gets about $2,500 a month off of, that he's got like this monthly income to live off of. So, I mean, it just depends on how you want to deal with it. He is getting older. And the reason he sold them off though, is because he got sick of dealing with, people having to fix things like the plumbing, this happened and that happened. And he got sick of that over time. When he was younger, it was fine. But as he got older, he wanted to get out. As far as condos go, I guess I don't understand that question about that. Catherine, can you elaborate on what you mean by that as far as building wealth? Can she unmute herself?
Yep, I'm here. Can you hear me?
Yes.
Okay. I was just wondering how you felt about condos as far as buying it to even live in, because I'm getting older. I don't have the energy to take care of a house. And, there's some unforeseen sometimes, with reserves and things like that.
Yeah, I mean, I agree with you. I've never been a big fan of condos. They still appreciate, just like a real estate, a house and stuff. They typically don't appreciate as fast as a house, and they definitely depreciate faster in a down market. So like in 2008, for example, I mean, I hate bringing that market up because it was awful, and that was based on fraud, you guys. So it's not a true market in any sense of the word. But if you look back at that time, houses declined by 20%. I saw condos in some areas, even in Kirkland and stuff, that depreciated by 70 or 80%. And mainly it was because of the reserves and things you were touching on, Catherine. So I think I think condos are a more affordable option for a lot of people. And so I think it's a valid option to get into something that you're living in, especially in your case, if you're getting older and don't want the maintenance and stuff. I think you just got to really vet out the HOA, in my opinion. You got to vet out who's managing it. Like, I think a lot of problems come when you have people that own the HOA, or excuse me, own a condo in the HOA that are actually managing it. That scares the crap out of me. I'd prefer to have a third party, someone that's more responsible and does it for a living. I would love anybody's input that wants to jump in on the condo question. But my feeling is just they're harder to finance. They do have a higher risk because of the HOA, but they still grow. I mean, I think they're definitely a valid option for a lot of people.
Thank you.
Yep.
Do you mind if I chime in?
No, go ahead.
Well, I think over time, because I work with a lot of like investors and whatnot, and I've seen investment properties and the way they appreciate and how they're handled. I would say condominiums generally may not be the best investment unless you have a very well managed HOA. The variable, I guess, rates of HOA dues are what is the biggest concern. If you're able to if you make sure through the resale certificate that they're well budgeted, that they're well managed, they don't have deferred maintenance that causes major issues later, it could actually be okay. But conversely, if you have one that isn't well managed, that doesn't have a good budget, then that could bite you in the butt in the next in a potential downturn. That's the only thing I'll say.
Yeah, I agree. You just got to be super careful. And Martha, I know you're situated with your condo in the HOA. I mean, another downside of the condo is that the HOA has a lot of control over how you use the property, like whether you want to rent it out. They might have rental limits. And those are actually good because they help financing wise. If you have a rental limit, a lot of financing types have rental caps. Like FHA, for example, has a rental cap. So only so many units can be rented out within the complex. So having a rental cap is good, but if you're buying it as an investment, it's bad, because you might not be able to actually rent it out. And I think, Martha, you found too that you were thinking about renting it out, but they were going to come down on you hard because you were having issues there. And
that is correct.
Yeah. What's that? Yeah, didn't you really? Yeah, what was that all about?
So Catherine, you got to really think about that because I have no control over my property besides paying my mortgage and my taxes. So where I live, Casper Village, they control everything and they're very strict with what you can rent and who you can rent to. And I'm surrounded by a bunch of old retirees from Boeing. So they make all the decisions in that gated community. So as soon as I get some more money, Jeff is selling me a single family home and I'm getting out of this condo. We hate our home. We're very honest about it, Catherine. I hate my house because I have no control. I fucking hate it.
Oh, geez. Yeah, it's tough. You've had a bad experience though from the beginning. That was unfortunate. It's too bad, but hopefully we can get you out of there sooner than later for sure. Someone asked about student loan debt too. I mean, student loan debt's at a very low interest rate and it's a longer term debt. So with lower payments and stuff, in a lot of cases, depending on your income limit, it's also tax deductible. So that's typically the least of our concerns debt wise is student loan debt. So I would say credit cards are key to get rid of those. Car loans and student loans are the least of our concerns. I don't think you necessarily need to get really aggressive on paying those off. I think saving and making the regular payments on those other kinds of debts initially are something that you can focus in on. Now, once you get to a point where you've eliminated your debt, credit card debt, and let's say you have a car loan and you'd say you got a couple of student loans, but you're in a process of saving 20% every month and that's going really well and you've saved your stuff like that, you can start looking at throwing an extra $100 or $200 towards the car loan or the student loan and things like that. I prefer paying off car loans only because they're depreciating assets. So paying a car loan off as quick as possible. Like I'll still finance my cars to get like free interest or 1% or whatever, but I'll finance them on shorter terms, like 36 or 48 months, and then I'll pay them off in a year or two. I mean, I get super aggressive on any debt that I take on, but I finance it because I don't want to take money out of my savings or my investments to buy a depreciating asset. That's a mistake. But I'll finance it using somebody else's money at a really cheap rate. You know, like they're offering 0 and 1% and whatever all over the place. I mean, even used car loans are below 4%. I mean, that's cheap money. Might as well use that money, get the best rate you can with whatever term. I don't even care about the term of the loan, but then get aggressive on paying that off if you have the extra money above and beyond the 20. And that could be $50, that could be $100, it could be 400. You know, you could double the payment, whatever you want. Student loans, on the other hand, I mean, those are tough ones. I mean, I would still focus in on the savings at the end of the day. Credit cards are where we really get killed.
Here's a follow-up question on that. Would you pay them at all? Like, would you defer? Because there are programs where you can like completely defer your student loan payments.
No,
and
you want to set up some kind of
pay them.
I'm sorry?
Because I've heard that you mentioned the strategy of like refinancing your house to pay off your student loan debt later on. I mean, is that?
I mean, I like the idea of using the home equity to pay off debt and get everything strategized into one payment. Like having one payment has been talked about. I mean, you look at all kinds of wealth building sites, having one payment versus 10, you're going to save more and pay off debt faster by having one over 10. I don't care. You know, Dave Ramsey doesn't like using cash out on a home. I disagree. I've done it and it saved me when I did it. And I paid off my student loans, actually. This was back in 1998. I had a ton of equity in my house back then. I pulled out a home equity line of credit. I paid off my student loans, a couple of car loans, and combined everything into it. And then about a year later, I sold it. Guess what? I didn't have any debt. You know what that feels like? It feels amazing. And the key with that, though, guys, is I didn't go back into debt either. Like a lot of people will use their home equity. I mean, and it's unfortunate because I've been doing this business for a long time and I've seen a lot of clients do it, where they'll take out the home equity, pay off $30,000, $40,000 in debt, and then call me a year later and have $30,000 or $40,000 in debt. Like the point of doing something like a home equity loan or even a cash out refi to pay off debt and consolidate everything in is to do that and to make your financial picture better, not to go back into debt. So if you have a plan going into that, then it will work. If you don't have a plan and you're just going to continue living life the way you have, you're probably going to run yourself into more debt, and I would probably talk you out of doing it. But I like the idea of consolidating everything to one, because now you can pile more money in one place rather than having to separate it out into 3 or 4 or 5 or 6 different debts that you have to pay off. So consolidating the student loans, I'd be okay with that. I think you do want to make minimum payments. I mean, the thing I like about student loans is 1, low rates, and 2, you can get a really long term so that you can, I would get the payment down as low as you can, but then try to pay extra when you can, as long as you're hitting your 20-year fix, your 20% savings. The key is getting in that habit of saving 20% every month out of every paycheck. And that's net income, guys, not gross. And yes, it sounds like a lot, but you get used to it as quickly as, I mean, it's just interesting the way once you get in the habit of it, you start to see how it's working. You start to see where your money's going, and it just happens. Oh, we got 2 of those. So here's that next class coming up too, stocks and bonds. I think this is where a lot of people, once you get into that savings, and if you've got the savings account, I see a lot of people that got 100. I mean, I just talked to a guy the other day that had like 400,000 in savings. And I'm like, dude, you need to invest some of that in stocks and bonds. And his question was the same as a lot of people is, I don't know how to do that. I don't know where to put my money. I don't know what stock to buy. And this class, I mean, I've talked to this guy. They've managed my money since 2005. I mean, they're just amazing. And it's kind of a down to earth with consultation too, with their program and stuff. And it's something that we've kind of, he's been working on, this Mark Naus guy, he's been working on this plan for years. And I think you guys will get a really good benefit from the class to learn how to invest and build wealth at a higher level, because this is where it all changes right here. All right, any last questions?
There's one more kind of specific one in the chat. I don't know if you want to address that. Buying a home in another state if you're moving there short term.
Yeah, Ferran, how long do you plan on staying there, do you think?
Hi, Jeff, can you hear me?
Yeah, go ahead.
So I'm not sure, maybe a year or two, but anything can happen.
What state is it?
Oh, here, Washington?
Oh, are you from out of state then? You're looking at buying a house here?
Yes, I was actually, Eric, I think he's on the call. I was talking to him, but then
Oh, sweet.
I kind of stopped because again, I ran into that 30 to 40% issue with the cost of the house should be or rental or whatnot. So kind of hesitated a little bit, but then this was my main concern.
Well, my follow-up to that was the reason I asked you what state was it would depend on what state you're moving to. Like, if you're going to Ohio, I don't know if I would say yes, but if you're coming to Washington, I mean, the market's tight here. There's not a lot of inventory, but it's going up like leaps and bounds. So I feel like if you bought a house today and even lived here for a couple of years, that you're going to have some pretty solid equity in the house where you could make enough money to make it worth your while to buy. So I feel like it depends on the market, especially if you don't know exactly how long you're going to be here. The downside is obviously if you're only here for 6 months or a year or something like that, then it's going to be a little tougher depending on how much you put down to kind of make out from the closing costs and everything else when you sell the house. So I guess you'd have to kind of dial in like that length of time that you're going to be here. If it's just for a year, I'd probably rent. But if you're going to be here for like a couple of years, maybe 2 to 3, then I would consider buying.
Yeah, it's been 2 years already, but the main concern was that the 30 to 40% rule you talked about. I was like going way over if I do purchase something here.
Well,
'Cause,
that 30% rule though only applies to your primary. So if you're buying secondary houses, then that goes out of the window. Like I have a house down in Palm Desert, and that pushes me over my limit, but I feel comfortable with the payment and stuff. So that's just a rule. It's not necessarily, it's a rule of thumb. It's not necessarily a steadfast rule. It depends on your financial situation. Second homes are actually light in the program. I mean, they like the second home part of it. They just don't like for whatever reason, they don't love the rental part of it because of the effort that you have to put into rentals. But there's plenty of people out there that do this program that have rentals as well. I mean, in my coaching class that runs this program and stuff, I mean, there's probably 60% of the people have rental properties. The coach always tells them to sell them, but that's just him. He's had bad experiences and doesn't like the effort, and he'd rather put money in stocks and bonds, and he's the coach, so he can say whatever he wants. But I say if you're buying a second home or you're actually living here as your primary, then it makes a lot more sense that way. I wouldn't worry about the 30% rule.
Interesting. Okay. I have something to think about, I guess. Thank you,
Yeah.
Jeff.
I mean, if you want to, I mean, and Eric and I work together, I wouldn't mind talking with you more depth with it and, giving you some more insight on that aspect of it. No problem. So if you want to get on a call, just give me a call, shoot me an email, and we can chat a little more on your situation. Do we have an application with you? Did you get that far?
I started and then I think I had a little bit more paperwork. Yeah, more paperwork.
Once we get that in, I could look at your overall, profile and give you some feedback on it. I mean, I'm not an expert in your financial situation, but I could give you my opinion based on what I see on your application and your assets and things like that.
Okay, yeah, that would be cool. Yeah, thank you.
Yeah, no problem at all. All right, anything else?
That was awesome. Great job, Jeff.
Thank you. Sorry, I stumbled there a little bit. I needed more caffeine, I guess, but got through it at the end. Well, thanks everybody for being on. I appreciate you all. Make sure you sign up for this next class coming up on March 16th, and hopefully something helped today. And if you have any other questions, reach out to me anytime. Thank you so much, guys. Appreciate y'all.
Thank you. Bye. Thank you.
Thanks, Jeff.
You bet. My pleasure. Good to see you, Smit.
Good to see you too, buddy.